Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The US Federal Reserve left interest rates unchanged and signaled it would stay on hold through 2020. Chairman Jerome Powell said the FOMC might consider buying short-term coupon-bearing securities to ease liquidity. Government expands the partial credit guarantee scheme introduced in this year's budget to allow state-run banks to buy lower-rated assets from non-bank lenders. Bharat bond exchange-traded funds of 3-year and 10-year maturity open for subscription today. And the Rajya Sabha too passes the Citizenship Amendment Bill that offers amnesty to illegal migrants based on religion. The army and paramilitary forces have been deployed in Assam and Tripura amidst severe protests. Well, let's take a look at the trade setup for the day. The world markets, well, they were flattish, but you would have to say that on an intraday basis, post Jerome Powell's commentary and the decision that they gave, they did trend a bit higher. So if you look at the close, it will look as if the US markets ended very, very flat. At least the Dow Jones and the S&P did. But NASDAQ up about 0.5%. But intraday, as was the case in trade yesterday too, there was a bout of volatility or a bout of intraday movements that were there, which belied what happened at close. So as I said, the close may look very, very flattish, but otherwise there was some uptick out there in the US markets from the lows of the day. Now, is that showing in on the rest of the markets in the world? Well, maybe not. You would argue that the Asian screen is mixed, and not just Nikkei, Shanghai and Hang Seng. If you look at the other screens as well, there's a bit of a flattish move to marginally mixed picture. Kospi, Straits Times, Australia, etc. And the SGX Nifty for now indicates a start which is in the green. The question is, can it hold amidst the kind of uncertain data that we're getting for the Indian markets? That's essentially the key thing. Now, yesterday I was surprised that the Indian markets did what they did, and we'll get to the big news in a bit, but just want to mark on the trade setup what I think might be the course of action for the Indian markets, and no one to predict really, but I was really surprised with the kind of moves that we had yesterday for the Indian equity markets, despite the fact that S&P's comments came out which warned of rating downgrades if growth does not pick up. And look at the 10-year yield that's hardened quite significantly from 6.4546 odd ahead of the policy. We now have the 10-year bond yields when we shut shop for the equity markets yesterday, trading at nearly 6.74. So there has been marked uptick, about 30 odd basis points or thereabouts in the 10-year bond yields, and that tells you something, right? That it's a bit of a lead indicator of sorts as to what's happening. 6.76 is actually northwards of 30 basis points from the start of the day that the policy was held. So that tells you something. I mean, is it that the bond markets are trying to price in some more fiscal slippage or some more easing there, or is it something else? Is it fears of what could happen to interest rates and yields if indeed the rating agencies change their outlook meaningfully? All of those, but equity markets belied all of that. So they did reasonably well in trade yesterday, and they may start off well today, but somehow I find it difficult to presume that amidst all of this and amidst this set of uncertainties and the fact that foreign institutional investors aren't too kind on India right now, how will we be able to keep up the momentum that we saw in late trade yesterday, or we might see in early trade today? So that's essentially the conundrum to my mind, but let's wait and watch. You never know. Surprises do happen, and we might get one in today's session too. Amidst all of this, I think there are 2 or 3 names that one would want to watch out for in the session today. Start aside of the regulars, which might move up and down based on the market momentum. 2 or 3 names. The listed stock, which is the Ujjivan Holding Company. Remember the small finance banks list today, and the back of the envelope calculation seems to suggest that if indeed the listing for the SFB is sub 55 rupees per share, it may result in pressure on the listed holding company based on the discounts that people give to the holding company across various listing prices of the small finance bank. So do watch out for Ujjivan Financial and watch out for that number. The expectations of the listing premium being 30 rupees has come off quite a bit. If it slips below 55 on listing, it might put pressure on Ujjivan Financial. Bharti Airtel has come out and said that the reports of deal with Dish TV are speculative at best. Dish TV actually gave out those verdicts in trade yesterday itself. Though, despite all of that, brokerages have come out and given out some notes on what this would mean as an entity. But I doubt that there is a meaningful belief that this would really result in some bit of upticks for Dish TV, which is why Dish as a stock didn't react too much yesterday. Bharti Airtel, even if this happens, will not really mean too much for the stock because there are other pressures at hand and other pulls at hand for Bharti Airtel. But do watch out. Consistent news flow out here would be interesting. And I dare say HDFC Life would be an interesting one. Remember, 2 days ago, we spoke about how the monthly AP data for all the private life insurers are very good. Now they held an analyst meet which showcased their digital prowess. They called it a technology day, and almost all brokerages which attended that meet have come back very, very impressed. And I've seen notes from Morgan Stanley, Jefferies, Kotak, Motilal Oswal, all of them writing fairly positively. They are fairly optimistic about the kind of stuff that HDFC Life is trying to do, and the outlook seems to be positive. Do watch out. It's got 2 pieces of good news now in the last 4 or 5 days. Maybe, just maybe, there could be traction on the stock. Let's wait and watch. However, let's tell you what's lined up on First Word today. It doesn't get bigger than the FOMC and the Fed decision. Kathleen Hayes first runs up through the reasons why all the FOMC members voted for staying put on the key rates. And we also speak to Peter Cardillo of Spartan Capital Securities on the implications of the Fed hinting at staying put in 2020. Nikunj Ohri then runs us through the key takeaways from the decisions taken by the cabinet yesterday. Nikki then tells us all about the 2 Bharat bond ETFs that opened for subscription today and the constituents of the 2. The US dollar and treasury yields dropped after the Federal Reserve kept interest rates unchanged in this week's policy meeting. Chairman Jerome Powell signaled the FOMC may stay on hold for all of 2020. Kathleen Hayes of Bloomberg News reports.
First time there was no dissent this year, but importantly, we know Jay Powell had sent out signals, many Fed officials had sent out signals that even the outliers, even Eric Rosengren wasn't worried about inflation on the hawkish side, even Jim Bullard on the dovish side, conceding that the Fed maybe would need to pause. Jay Powell made it pretty clear the Fed at this point, after 3 rate cuts in a row, thinks it's done enough. Let's listen.
With our decisions through the course of the past year, we believe that monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and inflation near our symmetric 2% goal.
So there you have it. And when you think about what happens next, well, Jay Powell, of course, was asked, what, trade war was such a big deal. One of the things that drove those preemptive rate cuts, those insurance rate cuts. And he said, well, we did have that in the statement. We focused on global developments. Of course, they're also focused on the fact that inflation is low. But clearly, the Fed seems to be looking towards not the domestic economy. As a former Fed official, Dennis Lockhart, told us earlier, he, like the Fed, believes there's a strong consumer in the U.S., but definitely global developments pose a threat. If you want to get a rate hike, well, inflation is going to have to suddenly soar and go well above 2% and stay there, which it hasn't done in many years. Let's look at the dots now and take a look at what the dots depict. On the far left-hand side, well, everybody, after cutting rates 3 times, even the people who were not looking for that 3rd rate cut this year, obviously at the meeting today said, okay, we're going to do 3 in 2019 because we did. The next column of dots, though, that's the one that matters. You can see 13 dots along the bottom suggesting that in 2020, that's what that represents, there won't be any changes. The rate will stay as it is, the median at 1.62%. There are 4 dots, 4 FOMC members who are looking for maybe a rate hike this year. Fed officials always are very quick to stress, look, we're not pledging what we're going to do. We're just saying, here's what I think the economy is going to do. This is what I think we're going to do on rates if the economy performs like this. As Jay Powell said, we don't get hung up on the dots. We get ready to move when we have to.
Yeah, and they're rarely surprised. Let's discuss these implications with Peter Cardillo. He's chief market economist at Spartan Capital, joins us on the phone line from New York. Peter, good evening to you. Thanks for joining in. Somebody did an analysis, which I saw on social media, that of all of the last meetings that the Fed has done, it has rarely surprised. This meeting or the outcome or the commentary surprised you one bit?
No, not at all. I didn't think they were going to raise rates. There was one little surprise, I should say, and that is the fact that they basically indicated that perhaps in 2020 there will be no rate hike. But of course, all of that is predicated on whether or not inflation should begin to pick up. And I think the Fed chief was quite humiliated by the fact that so far.
I think we just seem to have lost Peter Cardillo. We'll try and repatch that line as well. Keep in mind, a lot of focus about what the dot plot indicates as well. Now, the Fed, after having cut rates 3 times in 2019, has suggested there will be a prolonged pause in all likelihood for all of 2020. But keep in mind, the market is expecting a funds rate of 1.32% by the end of 2020, which would essentially mean one more cut versus the projection of 1.625% from the Fed, which is no more cuts. The only question is which way the Fed will go. But I think we got Peter back. Peter, sorry, you were finishing your point. The line got disconnected.
Yes, I was saying until we see inflation, it appears that the Fed is going to stay on hold. Now, of course, inflation can flare up. And, of course, if the job market continues to stay tight and all of a sudden we see a pickup in global economic activity and we should see a price in, let's say, crude oil prices, then I think, that changes the outlook of the Fed. But for now, the Fed is basically somewhat puzzled over the fact that there is no inflation. And so until we see inflation, it appears that the Fed is not going to move.
Yeah, that also, well, if I read a lot of if I believe a lot of reports that are written, Peter, not just for the US, but for a lot of major economies at large, inflation might find it hard to make a meaningful comeback. So why is it that the market seems to be believing that there might be one more cut versus the Fed saying that there is going to likely be a prolonged pause?
Well, I think, it all depends on whether or not we get a quick resolution or at least begin to see some sort of progress on the trade talks with China. If we get some sort of relief in tariffs and, of course, some more goodwill gestures and finally some agreement in 2000 that is a meaningful agreement, then I think, that changes the whole picture. And in fact, some of the risk factors were basically missing from the Fed statement. And it appears that the Fed now seems to think that there will be some sort of a resolution, although obviously it remains somewhat of a risk. And so I think if we don't get a resolution to the trade war, then, of course, that ups the possibility of the Fed cutting one more time. But if there should be any positive movement, I just can't see how we can have growth at 2.25%, maybe even 2.5%, and have the Fed funds rate down to 1.5, 1.7. That would be quite risky in terms of accelerating inflation.
Peter, just one more thing. Never mind what Donald Trump may believe, the Fed, at least in its commentary, has said that they would not be shy of helping out the markets should the need be. Do you reckon that unless something changes meaningfully, and again on the trade front as well, as most people say that there might be a tariff deal and not necessarily a trade deal until maybe even after elections in the US, do you reckon the Fed would be nimble enough to do that? And for now might be on pause, but if the situation demands, they might go ahead and tinker with the rates as well.
Well, it's hard to say. I mean, I don't think that a trade deal certainly would relieve the pressures on the global economy, and probably it would boost economic growth here in the States close to maybe 2.25%, 2.5%. And so, again, one of the strongholds of inflation being somewhat muted is the strong dollar. And I believe that if we get movement on the trade deal, that the dollar probably could weaken somewhat. And if that happens, and of course the risk of inflation moving up a bit could be a real possibility. Now, of course, we would need sustained inflation, and we would need inflation that would really have to surpass the Fed target for the Fed to be worried. So, for now, that's not a concern. But I think a lot depends, as I said before, on the outcome of the trade war.
Okay, Peter, we'll leave it at that. Thanks much for taking the time out and being with us. That's the view from Spartan Capital from New York. And no big surprises out there. The Fed on pause for 2020. That's the big statement that came in, and Kathleen Hayes and Peter Cardillo speaking about that. Back home, a couple of important things as we wrap up First Word, or as we try and address First Word first. The cabinet has taken some key decisions on Wednesday, mainly aimed at reviving liquidity and ring-fencing the bidders under the insolvency process from harassment. Nikunj Ohri sums up the key takeaways from 3 important decisions taken by the Prime Minister and his cabinet colleagues.
The Union Cabinet has approved changes to the partial credit guarantee scheme for NBFCs that was introduced in the Union Budget 2019-20. According to the changes approved by the Union Cabinet, public sector banks will now be allowed to buy BBB plus rated pooled assets of NBFCs against the earlier criteria of having to buy only AAA rated assets of NBFCs. The changes now also cover NBFCs and housing finance companies that have slipped into the SMA 0 category. The SMA 0 category is when a principal and interest amount is due not more than 30 days, and this scheme will now has now been extended till June 30, 2020, and the Finance Minister has also been given powers to extend the scheme further by another 3 months. Remember, the partial credit guarantee, under the partial credit guarantee scheme, the government provides a one-time cover of first loss up to 10% or 10,000 crore, whichever is less, on the pooled assets that public sector banks buy of non-banking finance companies. The total corpus of this scheme has been kept at 1 lakh crore rupees. Besides this, the Cabinet has also approved changes to the Insolvency and Bankruptcy Code. The provisions have been added to safeguard the successful bidders of the resolution process from any ongoing criminal proceedings against the erstwhile promoters or the management of the stressed firm. The provisions have also been added to prohibit non-renewal, suspension and termination of licenses of business that a particular company is involved in, which is under the corporate insolvency resolution process. And also an additional threshold has been kept for initiation of insolvency proceedings represented by a class of financial creditors to avoid frivolous filing of insolvency proceedings. This has been kept, keeping under consideration the frivolous filing of insolvency proceedings against real estate companies by home buyers. Lastly, the Cabinet has also allowed NHAI to start its own investment infrastructure trust and also allowed it to monetize its road projects.
I just, my 2 bits out here, and again, we'll speak to a management to get a better sense. Magma FinCorp would be joining us for that quick perspective, but it's not that banks don't have liquidity. I think banks have been very, very choosy in trying to give out the monies where they want to. Remember, all the highly rated NBFCs are not having issues with liquidity. It is the trust deficit that banks and lenders have with some of the NBFCs stroke HFCs, and these relaxations would, to my mind, not mean that banks would go out and likely give out large ticket advances to some of these NBFCs which need the money, because the trust is not yet bridged. So yes, the intent is there to try and ease up the liquidity. Would a system which has liquidity and the lenders which have liquidity be able to move over that trust deficit that they have right now and give some monies to some of the NBFCs that need money? I think it's a difficult question. It's a right intent and probably the right move to do. Will it have the desired impact is a question mark, and maybe over the course of the next couple of months we'll get answers to this as well. Okay, the next piece on First Word is something that is unique in the sense in India. The Bharat Bond exchange traded funds open for subscription today. A first of its kind in India, as I said. The two funds consist of bonds issued by AAA rated state run PSUs, the proceeds of which will go back into the companies. Nikki Mirchandani is here with those details. Nikki, good morning.
Good morning, Neeraj. New product, relatively less understanding on this. So I'm first going to dwell on the basics first, where it's going to be a targeted maturity bond ETF, which has two options. Maturity period would be 3 years and 10 years for both of them. The underlying will be the Nifty bond index for this particular ETF. And for that matter, as just Neeraj mentioned, that it's going to be investing in AAA rated public sector entities. ETFs will hold bonds till maturities and the coupons will be reinvested. Now, let's actually see what's on block. At the short term, as I just mentioned, the 3-year option, there the yield would be around 6.69%, and the amount that Bharat Bond ETF is planning to raise would be to an extent of 89,521 crores. So there's a huge corpus that they're planning to raise. From this long term, which is for the 10-year period, there the yield is around 7.58%, and what they're planning to raise is around 59,527 crore. Now, actually, let's see how does this stack up as compared to when does this come in for subscription. Well, it's today that this NFO opens for subscription for anchor investors, and December 13 to 20 for other investors. If you're just supposed to look at how the bond ETF stacks up in terms of the allocations made to the various investors that they have proposed right now, for retail investor is just capped to an extent of 25%. So is the case for retirement fund, and it's equally divided between QIB, NII, and anchor investor. That again is 25% of your overall portfolio, bond ETF for that matter. And the minimum investment amount that they're looking forward to raise is that you have to minimally put up in this bond ETF will be to an extent of rupees 1,000 for that matter.
Yeah, and it's only 1,000 as opposed to what you have to do if you want to buy a bond in its first place. But which are the companies, Nikki, that are a part of the two bond ETFs?
Sure, I'm going to start off by the 3-year index first, where it's planning to raise around that 89,000 odd crore. Let's actually look up to the companies where pull up the chart there where we have the weightages allocated for that matter. In that case, you have REC, NABARD, and Power Finance where they're planning where maximum weightage is allocated. Now, excuse me for this one. This is going to be for 3-year maturity period, and a maximum amount of sum is going to be raised in for 19,715 crore coming in for REC. NABARD is planning to raise around 18,530, and through Power Finance Corp, they're planning to raise around 17,000. So bulk of the allocation, roughly around 45% of the portfolio, would be coming in or would be raised for these bonds. Now, actually, let's flip the chart and let's see it for 10 years. What's in for 10 years? If you can look at the chart out there and the weightages which have been allocated for that, there also you have NHAI bonds. Now, from those bonds, they're planning to raise around a 21,000 odd crore, which is a huge sum coming in from NHAI. Do bear in mind the fact that the kind of financial position right now that the NHAI is sitting with right now, Indian Railways Finance Corp and Power Grid. This constitutes 45% of your overall index. Having said that, and also talking about the views that actually most of the experts have on our show yesterday, we had Amit Vivalkar who said that he'd actually like to wait out to see how does this product pan out, see if the market makers, I believe the liquidity is a big issue coming in for bond ETF, if they would be able to match up with the NAVs. However, Kirtan Shah said that liquidity and predictability of returns probably is the best feature that this product has as compared to something like a FD for that matter, or for that matter even bond mutual fund. So clearly true contradictory view coming in on bond ETF, right?
Yeah, thanks, Nikki. Thanks for putting that into perspective. Well, that's a little bit of what you need to know about the Bharat 22 bond ETF. I urge viewers to log on to our website and try and look up a show that we did with Ratika Gupta as well as Value Research, Dhirendra Kumar as well, which speaks about some of the highlights of this product. Keep in mind, liquidity remains a constraint. Edelweiss AMC has been on record saying that they have appointed market makers in order to try and reduce this gap of liquidity and therefore the expenses that come along with the market makers. Let's wait and watch if that happens. Some people would choose to wait and watch how this shapes up. Some people might be confident enough that instead of a fixed deposit, if you want to hold till maturity, which is 3-year and 3.2-year period, then it might actually be a good option as well. So Do read up on this before you try and invest out here. It might be a good product which might suit your need, but it's best to know about the product before you try and invest into it. So that's all that we have on First Word today. Lots more lined up on Indian Open. We discuss markets and macros with S. Krishna Kumar of Sundaram Mutual. S&P warns of a rating downgrade if India's growth doesn't recover. We speak to Upasana Bhardwaj of Kotak Mahindra Bank. Discuss the slowdown in automobile demand with Vinkesh Gulati of the Federation of Automobile Dealers Association, and talk to Dinanath Dubashi of L&T Finance about the company's 1,500 crore fundraising. But after this break, a full tilt towards the day's trade.